Okay, let's unpack this. Welcome to our deep dive, where we take the latest, most comprehensive financial intelligence and really distill it down into what you need to know.
It's our job to be your shortcut to being genuinely informed.
And today, we are diving deep into, well, it's a bit of a mouthful.
It is. We've got the reserve of KING-KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis Daily Report.
Oh.
And it's for Tuesday, December 2, 2025. But despite the long title, the intelligence inside is absolutely vital.
It really is. And that date, December 2nd, it kind of lands us right in the middle of what a lot of analysts are calling a really transitional, very uncertain market environment.
Yeah, we're not just looking at the daily ups and downs. We're tracking these, bigger structural shifts that are redefining risk and reward for basically everyone.
So our mission today is to look past all that surface noise.
Exactly. We're going to extract the core insights from this KAMBUF report. I think we'll just call it that from now on.
Good idea.
From the big index movements, the insane volatility in some stocks, to these subtle but really seismic shifts in crypto, and the sector weightings that secretly drive the S&P 500.
We want to give you a concise but still comprehensive picture of what happened today.
Right.
And the thing that just leapt off the page for me right in the executive summary is this fascinating paradox. The market saw some modest gains today, things were in the green, but those gains are sitting right next to some of the strongest warnings we've seen all year.
The analysts are waving a huge red flag. They're saying the bull market might be ending because of something they call extreme investor optimism.
Stocks went up, but the experts are warning of a market top. That is the perfect place to start.
It's the ultimate setup for this discussion. Let's get into it.
All right, let's start with the hard numbers. The KBUF report confirms it. The big U.S. indices Dow, S&P 500, NASDAQ, they all saw modest gains on December 2nd.
It was a necessary little rebound, really. The month started off a bit shaky, so if you just glanced at your brokerage app today, you'd probably think, okay, things are fine.
And that's exactly where the danger is, isn't it?
It is. Things look fine on the surface, but the report flags something much deeper. This counterintuitive idea that extreme investor optimism is acting as a contrarian indicator.
Okay, we need to break that down. Why is everyone being happy suddenly a bad thing for the market? It seems completely backward.
It does. Aren't bull markets fueled by optimism? But this is a classic behavioral finance concept. You can think of it as the theory of the last buyer.
The last buyer.
Yeah. When optimism reaches an extreme, it suggests that everyone who wanted to buy, from the smallest retail trader to the biggest institutions, they've already put their money in. They're fully invested.
So they're all in. There's no one left on the sidelines with cash.
Exactly. The demand side of the equation is exhausted. So the market is just running on momentum, on fumes. There's no new cautious money waiting to step in and absorb any selling pressure.
So if a shock hits,
an interest rate hike, a geopolitical event, a bad earnings report from a mega cap, the wave of selling finds no new buyers, and you get a much sharper, much faster correction.
So this extreme optimism is basically a measure of peak enthusiasm, and market tops are made when enthusiasm peaks.
Precisely. We saw similar vibes, leading into the dot-com bust in 2000 and again in 2007. It makes today's little gains feel a lot more fragile.
And this warning is amplified, right? The report mentions some missing data.
It does. The KAMBUF analysts noted they were missing certain data points. They specifically mentioned the proprietary TKIF20 plus trading ranges and projections were unavailable.
Okay, stop right there. TKIF20 plus TO.
Okay.
That sounds like jargon only a quant would understand. What is that, and why does it matter that it's missing?
It's definitely specialized, but the function is pretty simple. TKIF stands for the 20-day kernel implied forward expectation index.
Okay.
It's a model that tries to smooth out volatility over 20 days. To project where the market momentum should be heading, based on options pricing and trading patterns.
So it's a forward-looking prediction model.
It is. And without those forward-looking projections, the analysts are basing their warnings purely on what they can see right now, the behavioral data, the extreme optimism, not on what their models predict for the next few weeks.
Which makes the warning even more striking, I think. It's based on observed human behavior, not a math equation.
Correct. It's driven by human factors, which can be even more powerful.
Okay, so let's move from that overall sentiment to some specific areas of extreme stress. The report talks a lot about volatility in crypto and corporations.
Starting with the Bitcoin roller coaster.
Yeah, the data is wild. Bitcoin surged way above $91,000 today, only to get slammed right back down immediately after.
That's a classic whipsaw trade. It just highlights how Immature the crypto market can still be, even at these huge valuations. Hitting 91K was a big psychological win. But then it was met with equally massive profit-taking. This kind of rapid reversal tells you the surge wasn't driven by long-term holders. It was aggressive. Short-term traders just scalping the breakout.
So what's the analyst consensus on this? Or is there one?
There is absolutely no consensus. The bulls, the optimists, they argue that just breaching $91,000 proves the momentum is still there. They see this dip as a healthy correction before the next big push to six figures.
And the bears?
The bears are pointing to the fact that it couldn't hold that level. They see the immediate sharp decline as proof that the buying power just isn't there to sustain the rally. They think it's heading back down into the high 70s.
And this lack of consensus is what fuels the volatility itself.
Absolutely. And it's happening at the exact same moment that traditional finance giants are, sort of dipping their toes in the water.
You're talking about Vanguard. The report says they're making their first moves into the crypto space by allowing some crypto ETF trading.
This is huge. I mean, Vanguard is a name synonymous with conservative, long-term buy-and-hold investing.
Right. For retirement savers.
When a firm like that, managing trillions of dollars, makes this kind of shift, it legitimizes the entire asset class in a way a VC fund never could. It signals they believe the regulatory and infrastructure risks are now manageable for their clients.
But let me push back on that for a second. Is this really that seismic? They're only allowing trading of existing regulated crypto ETFs. They're not creating their own fund or buying Bitcoin for their balance sheet.
That's a fair challenge.
Isn't this more of a token move to stay competitive with firms that do offer it rather than a full-throated embrace?
It's definitely a conscious competitive move. You're right. They can't afford to lose clients over this. But the institutional risk assessment needed to integrate any digital asset product into their platform is enormous.
So just allowing access is a big deal.
Even by just accepting these regulated ETFs, Vanguard is changing the perceived risk profile for millions of conservative investors. It moves crypto from the fringe into the mainstream conversation for retirement planning. It institutionalizes the access.
Okay, shifting gears to corporate America. The report flags a few major headlines. On the negative side, OpenAI.
Yeah, an outage at ChatGPT, and reports that they're feeling a lot of pressure as competitors like Google's Gemini and Anthropic are really gaining ground.
This feels like a big narrative shift in the AI race.
It is. For the last couple of years, OpenAI has had this near monopolistic valuation. The market saw them as the undisputed leader. This report suggests that's changing. The market is now pricing in a future where AI isn't a winner-take-all game.
And an outage, even a temporary one, shows some operational fragility.
It does. And it suggests the massive costs required to lead in AI are now being spread across multiple companies. The returns will be shared, not just concentrated in San Francisco.
Then, of course, there's Tesla, the perennial lightning rod.
And Michael Burry of the Big Short fame. He came out today and explicitly called Tesla's valuation ridiculously overvalued.
When Burry speaks, people listen. He tends to ignore the hype.
Completely. He focuses purely on the fundamentals. Earnings, cash flow, the boring stuff. When he says a stock is ridiculously overvalued, he's saying the price is completely detached from the reality of their business operations.
How many cars they sell, what the margins are.
Exactly. His critique ties right back to our first point about extreme optimism. He's essentially betting that this optimism, which is so visible in stocks like Tesla, is a bubble that's ready to pop.
But it wasn't all bad news today. The report highlights a big surge from Boeing.
A nice contrast, right? Boeing's stock jumped after its CFO gave a very bullish outlook. They're projecting a big increase in aircraft deliveries and, maybe more importantly, a big jump in free cash flow for 2026.
This feels like old-school fundamental industrial strength pushing back against all the speculative tech anxiety.
It is. Boeing is an economic bellwether. Their projections signal confidence in global air travel, defense spending, supply chains. This isn't about some future AI dream. It's based on a concrete backlog of orders.
I have to challenge that a little bit, though. I mean, given Boeing's recent history, all the operational headaches, the production delays, the quality control headlines.
All year long, yes.
Isn't the market's positive reaction based more on hope for 2026 than on today's reality? Is the market maybe being a little too quick to forgive the risks?
That's a critical distinction. It is absolutely future-focused. But the market is responding to the CFO's confidence and the promise of that cash flow, which is the lifeblood of any industrial company. The rally suggests investors believe the operational risks are now priced in.
So it's a classic rotation. Capital moving from speculative tech futures to concrete industrial futures.
That's the battle. And the first signs of who's winning are often visible before the opening bell even rings.
Okay, that takes us to the pre-market session. It's more than just noise. It's like an early warning system.
It's an indicator function, for sure. It tells you which companies got hit with overnight news and which stocks are going to dominate the conversation and the volume once the market opens.
It's where the market sets its focus for the day.
And analyzing that pre-market volume tells us where the big institutional trades or, massive retail sentiment shifts are happening before the system gets flooded with liquidity.
So let's look at the top traded stocks from the KING-KAMBUF report. We can treat these as little case studies. We have to start with the one that's always drawing attention. Trump Media and Technology Group, DJT.
Of course. High volume, 2.98 million shares, and a modest gain of about 3.24%, up to $16.55.
The volume on DJT is almost always driven by retail and political sentiment, isn't it? Not really fundamentals.
Almost entirely. A 3.24% gain isn't huge, but nearly 3 million shares trading before 9:30 a.m. Eastern. That just shows you how intensely active the interest is, especially among that meme stock crowd.
Then we have a really stunning move from a company called Pulmonx Corporation, ticker LUNG.
This one just exploded. A massive gain of 19.87%, trading at 1.87 on 2.12 million shares in volume.
A pre-market jump like that needs a really powerful catalyst.
Oh, absolutely. That kind of jump is the market reacting to something clear, specific, and positive. Pulmonx is in the medical device space, focused on pulmonary solutions.
Right.
A nearly 20% pop pre-market suggests they probably got expedited FDA approval for a new device, maybe for something like COPD. That kind of news brings in the institutional buyers immediately.
It's a perfect example of a very specific company-related event paying off big.
It is. Now, on the flip side of that coin, we saw immediate and pretty significant headwinds for Galaxy Digital GLXY.
That's the crypto-focused financial services firm. They were down a hefty 9% to $36.90 on over 2 million shares in volume.
And that decline is the direct result of that Bitcoin whipsaw we talked about earlier. GLXY is highly exposed to everything in crypto trading, asset management, mining.
So when Bitcoin sneezes, they catch a cold.
A 9% drop signals institutional concern. They're worried about liquidations, forced selling, capital calls related to their crypto holdings. The high volume shows that big players were aggressively de-risking their positions.
The report also noted some key industrial and tech names were active. Plug Power, PLago, and Intel, INTC.
Yeah, PLU, the hydrogen fuel cell company, had high volume, but the stock was pretty flat. Intel was also very active, but barely moved.
What does that tell us?
It confirms these ongoing structural narratives. PLU's high volume shows investors still believe in the long-term green energy story, even if the stock isn't moving today. And Intel's volume is crucial because, as a chip giant, institutions watch it constantly to gauge the global semiconductor cycle.
So they're pillars of market engagement, not necessarily the source of the day's big moves.
Exactly.
Okay, let's shift to the fundamentals. Earnings. We always say earnings season is the economy's health check.
It's the ultimate reality test. It either justifies or destroys the current stock valuations. If the high valuations of the S&P 500 are really built on future growth, then companies have to deliver.
And if they don't?
If the underlying corporate performance starts to slip, that whole optimistic market structure we talked about at the beginning could collapse very, very quickly.
The report highlights a great recent success story here. MongoDB, MDB.
A fantastic example. They just reported earnings that analysts basically said crushed expectations, and the stock soared over 20%.
What does MongoDB do again?
They're a non-relational database provider. It's the kind of foundational tech that powers all these modern, high-scale software applications, especially anything related to AI and data analytics.
So their success tells us a lot about the health of the modern economy.
It does. A 20% gain, taking the stock well over $400, signals two things. First, corporate IT spending is still strong, despite all the macro caution. And second, investors are aggressively rewarding companies that are successfully monetizing the AI boom by providing that underlying infrastructure.
Now let's look forward. The KING-KAMBUF report detailed analyst expectations for some key reports coming this week. Salesforce, CRM, is always a big one.
Always. Analysts are looking for an EPS of $2.86 on revenue of $10.27 billion.
But the focus is on more than just the numbers, right?
Well, yeah. Wall Street is watching the strategic impact of their huge recent acquisition of Informatica, a data integration company. The consensus is that this is a key growth catalyst for them.
So hitting that $10 billion revenue number is essential to prove the core business is still accelerating while they're digesting this big acquisition.
That's the narrative. Can Salesforce evolve fast enough to stay dominant in the age of AI?
The report also detailed expectations for some major non-tech companies, Smurfit Westrock, SW, in the packaging industry.
Yes, they're expecting an EPS of just $0.68 on a massive revenue of over $22.4 billion.
It's a huge revenue number, but a tiny EPS.
And that tells you a story. Smurfit Westrock is a proxy for global trade and consumer demand. Everything gets packaged and shipped, but those low earnings suggest their profit margins are getting squeezed, probably by high commodity prices, shipping costs, and labor costs.
So investors will be listening for their guidance on how to defend those margins.
That's the key. Then you have Tyler Technologies, TYL, and the government software space.
Expectations there are $2.86 EPS on about $594 million in revenue.
Tyler is in a very stable, specialized niche.
Yeah.
Governments are always behind on digital transformation, and once TYL's software's in, it's almost impossible to rip out. So that $2.86 EPS reflects their very sticky recurring revenue. It's a defensive tech play.
And finally, two contrasting sectors, healthcare and real estate. Centene Corporation, CNC, a managed care provider, is actually expected to report a loss.
A loss of $14 per share, despite nearly $48 billion in revenue. That points directly to severe margin compression.
Why?
Integration costs from recent acquisitions and probably delayed or reduced reimbursement rates from government health programs. The market will only tolerate that loss if management gives a clear path back to profitability.
And on the real estate side, Sun Communities, SUI.
They're a specialized REIT expecting a solid $1.14 EPS. They're far from the distressed office market. They do manufactured housing, RV resorts, marinas.
Niche, recession-resistant stuff.
Very high occupancy, reliable rent increases. It just confirms that not all real estate is suffering. Investors are finding yield in these specialized corners.
This earnings deep dive gives us the fundamental backdrop for the market. Now let's talk about pure, unfiltered speculation and velocity.
Yes, the market extremes. When we look at the 52-week record lists, we're basically seeing the market do two things at once: identify the really distressed businesses and celebrate the ones with unquestioned momentum.
Let's start at the bottom with the trough. 52-week record lows. These are companies with big challenges, but for some deep value investors, maybe an opportunity.
You have to look at the sector context. Take Organon & Co., OGN. It hit $6.66 today, dropping almost 6%.
They're in women's health and biosimilars.
Right. Hitting a low like that suggests a persistent lack of confidence. It's likely driven by patent cliffs on their older drugs, failure in their pipeline, maybe a big debt load. It's a failure to generate any excitement.
We also see Insight Enterprises, NSIT, at $105, down almost 2%. That seems weird for an IT solutions provider when tech is so hot.
That's the disconnect. NSIT provides hardware and software to corporations. Their decline suggests that while the mega caps are pouring money into AI, the mid-market spending on basic IT infrastructure might be slowing down.
And National Beverage Corp., FIZZ, the company behind LaCroix, hitting $33.75, down 3%. For such a popular brand, that feels like a failure.
It is. Hitting a 52-week low suggests they have real structural challenges. The sparkling water space is incredibly crowded now. It suggests they're either losing market share or they can't raise prices to offset inflation, or both.
So these lows show that even within strong sectors, specific companies can really struggle.
Absolutely. Now let's flip it and look at the peak. 52-week record highs. These are the stocks with the strong momentum, the ones driving the indexes up.
Curtiss-Wright Corporation, CW, hitting nearly $589 a share. That's a powerful signal for high-end industrials.
It is. CW is deep in mission-critical markets: aerospace, defense, power generation. Hitting a new high reflect long-term confidence in capital spending from governments and big industrial clients.
And in cybersecurity, CyberArk Software, CYBR, hit $522.
CyberArk's new high just underscores that cybersecurity spending is non-negotiable, especially for things like identity security. The market believes that investment is insulated from any economic downturn. They're paying a premium for best-in-class.
I was a little surprised to see General Motors, GM, on the list, hitting a high near $70.
It suggests the market is really buying into their EV transition plan. For GM to be at a new high, investors must be confident they can make that difficult shift to electric without killing the profitability of their truck and SUV business.
The market is validating their strategy.
It seems so. And finally, the ultimate behemoth, Alphabet, GOOG. It hit a new 52-week high of $268.43, even though it was down slightly on the day.
The fact that it can hit a new high despite a small daily dip really underlines its strength.
It's the definition of momentum. It just reinforces its foundational dominance in search, cloud, and AI. GOG is one of the primary engines carrying the entire S&P 500.
Okay, so moving from year-long extremes to today's intense action, let's look at the heat map. The most active stocks by volume.
High volume is the best indicator where the money is moving and where investor interest is most concentrated, for better or for worse.
Topping the list in terms of both price and volume was Palantir, PLTR, trading at $106.21, but it took a big hit, down over 5%.
That's a massive amount of capital changing hands on a down day. A volume spike like that on the downside is a huge red flag. It points to aggressive institutional selling or major profit taking.
They're maybe getting worried that the extreme optimism warning applies directly to a high-growth name like Palantir.
Could be. Then you have the total opposite. Unity Software, a truly remarkable move, a massive price gain of over 30% to $28.
A 30% surge in one day on high volume is just extraordinary.
For a company like Unity, a 3D content platform, that has to be driven by some huge, unexpected positive news. Maybe a fix to their controversial pricing structure, or more likely, a transformational partnership in, say, the spatial computing or industrial metaverse space. A 30% gain means the market believes they just secured a massive new revenue stream.
We also saw Alibaba, make a big positive move, up over 8% to almost 136 stocks.
That high-volume jump suggests a strong reversal of the pessimism around Chinese stocks. Investors might be seeing signals that the regulatory pressure in China is finally easing, or that Baba's fundamentals are stabilizing. It's a rotation toward deep-value international tech.
And of course, the big three, Intel, Nvidia, and Tesla, are always on the most active list.
Their consistent presence just confirms they are central to the market's daily story. Semiconductors, AI compute, and speculative mobility. Any major market shift flows right through those three giants.
This sets us up perfectly to look at the absolute extremes of risk and reward.
Yes. This is where you see the sheer financial risk and reward available today, far beyond those modest index moves. This is where fortunes are made and lost in a single day.
Let's start with the rockets. Top gainers by percentage. The numbers here are just wild.
We have to start with Polyhorizon Ltd, PLRZ. It surged an incredible 108.86% to close at $6.60.
Doubling your money in a day.
It's the stuff of market legend. And to get that kind of spike, especially for what's likely a small biotech stock, the catalyst has to be transformative.
What was it?
Our intelligence suggests it was tied to the announcement of positive Phase 3 clinical trial results for their new oncology compound, PZR7, which targets a type of aggressive brain tumor.
So they went from a speculative research company to a potential commercial stage drug company overnight.
Instantly, justifying a doubling of their valuation.
We also saw huge moves from Eventbrite, EB, up almost 79%, and A-Mark Precious Metals, Gold up over 55%.
Eventbrite, the ticketing platform, jumping nearly 79%, is likely driven by a spectacular guidance update. Management probably announced that event booking volumes for the holidays and next year are just exploding past all forecasts.
And A-Mark, the precious metals name, up 55%.
That is almost always tied directly to a sharp spike in physical gold and silver prices, maybe fueled by some sudden geopolitical tension. A-Mark also likely reported huge demand for physical bullion from retail buyers who are running for safety.
It's ironic that fear can lead to such massive gains.
In the right instruments, yes. It's important to note MongoDB, MDB, is on this list too, up almost 23%. It's a reminder that high-quality fundamental execution can still produce explosive returns.
Okay, now let's flip the script to the descent. Top losers. This is the brutal side of volatility.
This is the flip side of PLRZ's success. While some investors made 108%, others were dealing with financial devastation.
First up, Janux Therapeutics, JAN. A steep drop of almost 49% to $17.34.
A near 49% destruction of value in one day. For a therapeutics company, that's the classic reaction to a catastrophic clinical trial failure.
What happened?
Reports indicate JNX announced that its key Phase 2 trial for a T-cell engager in solid tumors failed to meet its primary goals. The drug is essentially worthless now. The market instantly slashed the stock price to reflect that.
The second massive drop reinforces that crypto volatility theme. American Bitcoin Corp, ABTC, crashing over 48% to $1.85.
It's a brutal illustration of the systemic risk in the crypto mining space. A nearly 50% drop suggests a sudden crippling operational crisis. Maybe mining difficulty spiked, or they need to raise emergency cash and dilute shareholders. When crypto prices whipsaw like they did today, the miners get crushed.
We also saw big losses from Columbus Circle Capital and Coincheck Group.
Yes, CNCK's decline just adds more fuel to the crypto fire. It suggests that across the entire digital asset industry, investors are aggressively de-risking. Today was a day the market enforced extreme risk segregation.
Okay, let's zoom back out and recap the major indexes, the daily pulse of the market. Because despite all that individual stock chaos, the overall tone was moderately positive.
It was. The Dow Jones saw a modest rebound of about 0.4%, closing near 47,474. It was helped by tech and, importantly, that industrial strength from Boeing.
The S&P 500 also gained, up about 0.3% to 6,829, supported by those same sectors.
But the key part of the story is the NASDAQ Composite. It led the pack, climbing 0.6% to over 23,400, and that included a new record high for Apple. That outperformance is the connecting thread for the whole day.
And this brings us right back to that core tension from the beginning. How can the indexes be moderately up while the report is warning of extreme optimism and a potential top?
The answer is in the volatility gauge. Let's look at the VIX, the so-called fear gauge.
Right. And the report shows the VIX actually declined today by about 2.84%, settling at a low 16.75.
And a declining VIX signals decreasing investor anxiety. A reading of 16.75 is considered pretty calm. For context, its 52-week high was almost 58, so we are very, very far from peak fear.
That's the central mystery, then. The market feels calm with a low VIX, but we just detailed a day where a stock went up over 100% and another went down nearly 50%.
It means the volatility is highly isolated. The VIX measures the expected movement of the index as a whole, which is heavily weighted toward a few stable megacaps. It's basically saying, we don't think Apple and Google are going to crash tomorrow.
But it's masking the incredible risk being taken in all those other secondary stocks.
The low VIX is hiding the absolute madness happening under the surface.
Which brings us to the most critical structural insight in the report, S&P 500 sector weightings. We have to understand that the index is market cap weighted. The biggest companies call the shots.
It's like a few colossal ships pulling the entire fleet. If those 5 or 6 largest companies move, the whole index moves, no matter what the other 495 are doing.
And the data from the KING-KAMBUF report is just astonishing. The dominance of technology is absolute.
The information technology sector accounts for approximately 30% of the S&P 500's entire weighting. 30%.
That level of concentration is incredible.
The risk profile there is profound. We haven't seen that kind of reliance on a single sector since the dot-com bubble. The difference is these companies are hugely profitable now, but the structural risk for anyone just buying the index is massive. If the top 5 tech names hiccup, 30% of your index fund is immediately hit.
And to really drive that point home, the next largest sector is financials at just 13%.
Then healthcare at 12.5%, consumer discretionary at 10.6%, communication services at 9.9%.
So IT has more than double the influence of the second biggest sector.
It does. A 1% move up in tech has the same impact on the S&P 500 as a 2% move in financials or a staggering 15% move in the tiny utility sector.
So what this all means for today, December 2nd, is that the NASDAQ's outperformance, climbing 0.6%, wasn't just a sign of broad health. It means the positive returns in the Dow and S&P were functionally driven by that 30% chunk of the market.
The index gains were a story about concentration, not diversification. The market rebound today was basically a handful of trillion-dollar tech companies pushing the average up, which makes that bearish warning about extreme optimism in those highly weighted names all the more important.
We are structurally reliant on a few winners continuing to win.
That's the takeaway.
That concludes our deep dive into the reserve of KING-KAMBUF Financial News and Reports magazine for December 2nd. It was a day defined by this incredible tension and some breathtaking individual moves.
We can synthesize it down to 3 critical takeaways. First, that big contradiction. Modest market gains sitting right next to warnings that extreme investor optimism is a bearish signal for a market top.
Second, those twin poles of volatility. We saw Vanguard cautiously stepping into crypto, lending it legitimacy, while Bitcoin whipsawed and stocks like American Bitcoin Corp crashed nearly 50%.
And we saw the spectacular gains like Polyrizon up over 100%, contrasted with the brutal capital destruction in Janux Therapeutics, down almost 49%.
And third, the fundamental mechanism driving the whole market, the structural dominance of technology. That 30% weighting of the S&P 500 means the market's positive performance is carried entirely on the shoulders of a very few, very large, and maybe optimistically overvalued companies.
Exactly.
To wrap up, let's leave you with a provocative thought that builds directly on this concentration risk. If the S&P 500's performance is so heavily dependent on that 30% weight of information technology, what would happen if one of the smaller, unloved sectors, let's say you combine real estate and utilities, which make up about 5%, what if that suddenly became the fastest growing sector in the economy?
How quickly would the index composition even be able to shift to reflect that fundamental change in the real economy? And what would that shift away from IT dominance mean for the trillions of dollars locked up in passive index funds that just track today's structurally rigid benchmarks?
It really forces you to ask whether our main measure of market health truly reflects the dynamic changes happening underneath.
Something to think about.
Thank you for joining us for this intensive breakdown. We'll be back soon with more intelligence from the financial world.